Good Friday evening, everybody, and welcome to the Fonti International. I'm Alexandra Georgieva, and as always, we're going to be together for the following 1 hour and a half. As we can see, not really optimistic trading session on Wall Street so far. S&P 500 is dropping by 0.2%, Dow by 110 points, and Nasdaq Composite off 0.11%. The Russell 2000 is the only bright spot over there, which is pretty surprising because in general in the last few weeks it's been underperforming compared to all the three major averages. So far 0.05% in the green territory. The FANGs are pretty mixed up, half of them in the green, the rest in the red territory, but not by important declines so far. If we scroll a little bit, the SOX index is off 0.3%. The banking index is well down by a little bit more than 1.5%, and all the majors are off by more or less 1%. The USO is off 4%. The XOP, which is the S&P 500 ETF index, is also 0.5% in the red territory. So there is a little bit of red across the board. I want to switch very quickly to the fixed income board. So far, the US 10-year Treasury is yielding 0.65, the 2-year 0.16, and the 3-month 0.12%. Really interesting, interesting developments on the bond market, especially here in Europe. I want to show you very quickly the spread between the Italian BTP and the German Bund. So far, 207 basis points. As we can see, it's narrowing slowly every day by more and more. Very quick look also at the commodities. WTI so far off 3%, Brent 3% lower, and gold 0.4% in the green territory. I want to show you very quickly also the European trading session because it's been extremely volatile Friday here in Europe. STOXX 600 closed slightly above the flat line, actually 0.01% in the green territory, with food and beverages falling 0.6% to lead losses, while travel and leisure stocks jumped 0.8%. It's extremely interesting situation here in Europe, with all the story around the recovery fund. So hopefully we're going to figure out in the very near future what is going to happen and if it's going to become reality. And we're going to talk about it in the second part of the show. But first of all, I just want to remind everyone that in terms of European stocks, one of the stocks to watch is certainly AstraZeneca. Actually, the US has paid AstraZeneca up to $1.2 billion to secure almost a third of the first 1 billion doses planned for its experimental vaccine, while Britain announced today that it would acquire over 10 million coronavirus antibody tests from Roche and Abbott. So certainly this sector of pharmaceuticals and also biotech is the sector to watch in the upcoming days. I want to move now to China because it's been making headlines, of course, with the reunion of the Communist Party, the Congress of the Communist Party. China signaled it will impose new national security laws on Hong Kong, dealing a blow to the territory's autonomy as Beijing seeks to stamp out widespread pro-democracy protests that have challenged leader Xi Jinping. Beijing's lawmakers will review a resolution to set up and improve legal and enforcement mechanisms for national security in Hong Kong with consideration to new circumstances and needs. President Trump said details on Beijing's plans are not yet known and promised to address the issue very strongly if China proceeds. The surprise move would override Hong Kong's system of self-governance and reflects growing frustrations within China's leadership over the long-running and at times violent unrest that began last summer and has often targeted the Communist Party and other symbols of Chinese rule. I just want to remind everyone that Hang Seng closed down by 5.5% today. I just wanted to remind something actually historic. China broke with more than a quarter century of tradition by not issuing an economic growth target for 2020, a stark acknowledgement of the challenges facing the world's second largest economy as it grapples with uncertainties around the coronavirus pandemic. Premier Li Keqiang abandoned the country's annual gross domestic product target for the first time in more than a quarter century, citing factors that are difficult to predict. Of course, he's referring to the coronavirus. I just wanted to remind you that there is a second cluster of coronavirus cases right now in China. So, they're not perfectly back to work. Certainly after this announcement of the crackdown in Hong Kong, the US Senate reacted. It said that actually it's going to move to pass legislation that could restrict Chinese companies from listing on American exchanges and not only many other, of course, actions that we're going to discuss in a very while with my first guest this evening, Jean Ergas, Chief Economist, Tigers Financial Partners. Good evening, Jean, and thank you for joining us.
Thank you very much. Always the great honor, always the greatest pleasure. Thank you.
Jean, I was just saying, that this story coming from China is right now the major market mover because, of course, it's going to lead to further tensions with the United States, no doubt about it. It might also lead to tensions with the European Union because it certainly is cracking down, in Hong Kong. For instance, U.S. senators are introducing a bipartisan bill that would sanction Chinese officials and entities who enforce the new national security laws in Hong Kong and penalize banks to do business with the entity. So that's the very initial response to the Chinese movement. I was wondering, what impact do you expect on Hong Kong in case this, law will be adopted?
Well, I think it'll be quite strong, quite frankly. I think we're now giving up finally on this grand illusion, to use the famous title of the famous film with Jean Gabin, that somehow this one country, two systems structure could be maintained. I mean, this is an absolute fallacy. This is simply not going to work. I mean, the business of the Chinese government is not business. The business of the Chinese government is power, and everything else will be subordinated to a single aim. They have a dominant strategy, which is crush dissent. There's absolutely no space for dissent in this system. China is a more authoritarian country today and tighter control today, maybe also thanks to technology, which has advanced, than it was 25 years ago. So I think it's a very important point, to bear in mind. I mean, Chinese history, even under the Mao regime, at one point they said, let 100 flowers bloom, whatever it was. People went out, expressed their views, and they were promptly put in jail. This is not a country, or so it's not a political tradition of the communists which tolerates dissent. So I think there's some very big issues here, and I think the impact will be large, and people are waking up to the fact that, quite frankly, economic policy does not lead to political convergence, and that it's difficult to find sometimes a common ground when your only point of tangency is the production value chain, but you do not intersect on the most commonly held value, which is freedom. I mean, there is this dissonance, and we are not able to close the gap. So I think there's going to be a lot of reaction, and people are going to be very upset. But quite frankly, I don't think the Chinese government remotely cares. Chinese government says, look, I mean, for you, Hong Kong is some sort of bastion of democracy, because it is a bastion of capitalism. We don't mind the capitalism, we just don't want the democracy. Your syllogism is false, completely false. Remember, the Chinese Communist Party is fiercely nationalistic, and it will use this to the hilt to even justify its actions to the extent that it's accountable to virtually anybody except for itself internally. Remember, what was it that Stalin was reputedly said to Khrushchev one day? He said, you do not believe that Mao was really a Marxist. He said, Mao is a margarine Marxist who is using Marxism for nationalist purposes. And this nationalism is always there. So I think that the blow is going to be sharp, but people will continue doing business with China. Because before, US, Soviet Union, two countries, two systems, no point of economic tangency. Now we have US, China, two systems, one economy. And this is the problem, that we have somehow here a lopsided structure which is asymmetrical between sort of doing business and also trying to get along politically. And I think that what this is really doing, this whole story, is lifting the whole debate from the proxy level, the subset trade, to actually the real level which it belongs, which is the new power equilibrium.
I was wondering, do you expect any reaction, of the protesters? We saw more than 7 months protests in Hong Kong. So to me, it's going to be weird if they wouldn't be back because,
Well, I think they're back already. I mean, they're already saying that this is very wrong. I mean, you're already seeing some of the main activists stepping up and handing out leaflets, for example. Now, to what extent that the Chinese government, through its proxies in Hong Kong, will actually repress this for the moment is not known. But they're going to play the long game. I mean, you have to realize the Chinese government is playing the long game. The protesters play the short game. It is intermittent protest. Sure, the Chinese government can deploy endless means. I mean, the Chinese government at this point, I don't mean to make a morbid or a fake analogy, but it's like the Federal Reserve of repression when they say we have unlimited means. These people have unlimited means. They can just keep crushing them. And I think it's extremely important to bear in mind what the long game is. There was, of course, this hiatus status, for example, with Hong Kong, which was agreed in 1997. They said, look, you know what? Let's accelerate it. Who cares? and this is the end of that. I think what this really shows is the fact that there was absolutely no good faith when the Chinese government accepted this status. And I think they will come back, and then the world will simply accept it, because after all, China, Hong Kong is an administrative region of China. We are not in a Hungary situation of 1956, where the Soviet Union went into Hungary. In fact, they went in there because Mao Zedong told them to. It was very interesting. I once read this. So Chinese communists have a history of pulling out the gun when necessary, quite frankly, even in Eastern Europe, telling the Soviets what to do in Eastern Europe. But I think they're going to play the long game. And that's it. The rest of the world will sit there and say, well, at the end of the day, this was internal affairs, very unpleasant. What are we going to do? What are the car companies going to do? Simply decamp, lose 30% of their sales and 60% of their growth. And this is the gun they're holding to our head. We have structure which we can no longer deal with. I mean, I will not hesitate to say sometimes that I think in many ways we have created Frankenstein, like Mary Shelley, and we don't know what to do now.
What do you think about the fact that, that's the very first time since ages that, Beijing didn't give any indications regarding the future GDP, not even estimates,
Well, I think it's very significant. I mean, as they say in the United States, they took the Fifth Amendment, which is what you take in a U.S. interrogation when you do not wish to incriminate yourself. So they've taken the Fifth Amendment and they have said, well, look, we really can't formulate any kind of forecast. Well, I'm sure they can't. I mean, I'm sure it is very difficult at this point. What this tells me is two things. Is first, that the numbers are bad. They know what the numbers are going to be, but they're not telling you. So two, that in fact, all this we've heard from the apologists over the last 3 months, that this country was going to snap back like a spring and jump in there like Batman, is complete and rubbish. We did not believe at the beginning, because we never equated, for example, the return of X number of people to work, which could be considerable, with, in fact, an economy which is about to zoom forward. If these people had good news to give, they would have given it. They have not given it. And I think also that's hitting the price of oil. Oil is cash and carry. Oil prices were being kept up in part by this belief that the Chinese economy would boom and that the oil market could, so to speak, balance on one foot, which was the China EM axis. This seems to be going out the window right now. I think it's very, very significant. Very significant. There was a really strong number. They would have said, well, look, this forecast is a bit more difficult to make than the others, but they would have said something. They've said nothing. They've taken the Fifth Amendment.
China vowed to push ahead with a phase one deal. How likely is the fulfillment of the deal at this point in a possible phase two deal?
Look, I mean, they come out and said we intend to sort of implement the trade one deal. What does this mean? I mean, what are you going to do? You're going to start buying in this situation. I mean, now it's a complex situation. They can say, well, things are difficult. We're not quite sure if we can really go ahead with this. What they're doing is they're saying, look, let's leave a door open. We are fighting. But at one level, we need to keep the door open. And this is very typical when you're dealing with difficult governments. You fight, but at the bottom, in fact, or at the lower, not the bottom, but a more pragmatic commercial level, you keep the door open. I'll give you an example. We were fighting with Venezuela. We called each other names and what else? I mean, for years. We were doing a booming business in Venezuelan crude. So in fact, I mean, there is a duality to any relationship. So I think that what they're trying to say is, look, let's not shut the door completely. We do need you at some point. But I think that what they are going to be countering is a growing disaffection of a lot of the world with the way they do business and the risks involved in having a supply chain there. So, I mean, they're coming under pressure gradually. But I think it's a regime which really doesn't, quite frankly, because for the regime, the primacy is simply staying in power. And that's all there's to it, because it's an authoritarian structure. And it cannot legitimize itself through a vote. So what it does is it legitimizes itself through force. When I read these reports, they are accountable. They're accountable to nobody. Absolutely nobody. I mean, this is a regime which will kill 1 million people tomorrow. I don't think they would hesitate.
I was wondering, do you expect any particular reaction, of course, coming from President Trump? Because he looks like, liking the authoritarian regimes.
Oh yes, no. I mean, he's kind of into it. I think the man is a frustrated authoritarian in that sense. I mean, the whole strongman myth. I think, thankfully, in the United States, you cannot do this. We have a constitution, which I think is really, don't mean to boast, but it really is a great triumph of mankind. And I think it's rather difficult. But I do believe that no. I think that now he's drawing the line. They're drawing the line. The Senate has drawn the line. What is very important is that the Senate voted on a bipartisan basis. Both Democrats and Republicans found something to agree upon. That's very good. Now it's gone to the House. Pelosi says, well, we're going to review it. All right. So she's trying to be a bit more cautious here. She's saying, well, we do need to have a relationship with China. But the pendulum is shifting away from, let us put it this way, appeasement and trying to sort of apologize for authoritarian dictatorships. We are seeing it's just not working. It's just not working. We're having trouble on the trade deal. We're having trouble on certain political fronts. Now there's the question of Hong Kong. There's the Hong Kong Human Rights and Democracy Act, which people are asking now to be implemented, which requires the U.S. to audit, so to speak, compliance with certain guidelines, so on and so forth. We have this bill, which was, again, the one of the listing of the U.S. of the Chinese companies, which I think is very interesting because it does not specifically say China, but look, how can you, if you are operating in a country where there's virtually no separation of power, where the rule of law is a complete joke, actually come out and say, I'm doing business, but I'm not controlled by the government? Control is a very, very, very difficult thing to define. Because what you're really saying is, I do not depend on them for any favors, and I don't depend on them for any authorizations or for any influence which they may exert on my behalf. And this is obviously not the case in China, which is basically state capitalism.
Jean, let me ask you one very last question. Actually, just
Sure.
want to remind everyone that Hang Seng closed, the week in a very, very negative way, 5.5% lower. And of course,
Sure.
right now we do see also U.S. indices trading down. Of course, not significant decline, but still trading below the flat line after nice rally in the previous days. What do you expect from the markets considering the economic data, central banks, and U.S.-China tensions?
Well, I think it's very simple. First, I expect that the U.S. markets will take a step back after having had such a strong advance. It is only normal. People are actually taking profits. These markets are not only made up by investors, they're also made up by traders. So that's the first point. Secondly, what do I expect basically from these statements from the central banks? We have had Mr. Clarida, who is our vice chairman in the United States, come out and openly say we need more help. And it's going to be disinflationary pressures, and it could be rough riding ahead. We hope we will get more help from the U.S. Treasury. So let's bear that in mind. It is not a negative message, but it is a cautious message. We're listening to the Bank of England talk openly now about negative rates. Where is that bringing one of the world's leading economies? And also, what do we see now on the ECB front? We're seeing they're saying, we've got these notes, whatever it is, these minutes, and saying, well, we want to increase the pandemic fund. So I think the message is pretty simple. I think at the best, we're going to stabilize. I think there's going to be more volatility. People are giving, let's put it this way, the virus spread the benefit of the doubt and saying we have not seen a major resurgence. Everybody I speak to on the senior medical front says it's going to take 3, 4, 5 weeks to really see how this thing plays out. So I think it could get rough riding up ahead. The question will then be, will governments clamp down or not? The markets are betting the market governments will not risk another shutdown, but you just do not know. So I expect a fair amount of volatility coming up now. Will be hedged.
Thank you very much, John Ergas, Chief Economist, Tigers Financial Partners. Thank you for joining us. Have a great long weekend.
Thank you very much. Very kind. Thank you. Cheers.
I want to bring you an interesting story of the corporate world. As we can see, IBM is off 1.12%. Actually, International Business Machines is cutting an unspecified number of jobs in the first major workforce reduction under new Chief Executive Officer Arvind Krishna, who is trying to revive growth at the tech company. IBM said the cuts are aimed at making it more agile, but they come against the backdrop of a major economic slowdown triggered by a coronavirus pandemic that has caused many of its customers to dial back investments and hold off on big software deals. IBM's work in a highly competitive marketplace requires flexibility to constantly remix high-value skills, and our workforce decisions are made in the long-term interests of our business, the company said in a statement. The company didn't disclose the scale of the job losses. A person familiar with the company's plans said they are thought to affect several thousands people. IBM had around 350 to 600,000 employees as of the end of last year. So certainly it's going to be a major hit. Another stock to watch is Alibaba. We've been discussing this company. It's going to have probably it's going to have troubles considering the fact that the Trump administration is trying to tighten The Chinese companies that are listed on the US stock exchanges and the one that want to be listed in the stock exchanges. Actually, Alibaba's fourth quarter profit fell 88% from the same period a year ago as the coronavirus outbreak disrupted the Chinese e-commerce giant supply chains and hampered its ability to deliver packages. Alibaba, China's most valuable technology company, reported net income of 3.16 billion yuan, which is equivalent to $447 million for the quarter ended in March. The company said the fall in profit was mainly because of a net investment loss. A year ago, Alibaba had a net investment gain. Earnings per American depository share were 1.16 yuan, which is equal to 16 cents a share, compared with 9.84 yuan a share earlier a year ago. On an adjustment basis, earnings per American depository share were 9.20 yuan. Analysts expected 6.05 yuan a share. Revenue rose 22% to 114 billion yuan, exceeding the expectations of analysts polled by FactSet. So as we can see, Alibaba took a hit because of the coronavirus, that's for sure. We're heading for a very short commercial break, but stick around, guys, because we're going to break down the recovery fund, the European Union Recovery Fund. Fonti International, and I'm Alexandra Georgieva. As we can see, stocks are trading down in this Friday evening. S&P 500 is 0.13% in the red, Dow 0.4% in the red territory, and Nasdaq Composite hovering around a flat line 0.06% in the red territory. The VIX index around the 30 mark so far. As you very well know from our programming, we're going to focus on Europe in this segment. We're going to talk about the European Recovery Fund together with my next guest, Gabriela Rosana, Policy Director at Culture Action Europe and a Spania contributor. Good evening, Gabriela, and thank you so much for joining us.
Thank you, Alexandra. Thank you. Glad to join you tonight.
Well, as I was just saying, actually the 500 billion EU recovery fund proposed this week by Angela Merkel, the German Chancellor, and Emmanuel Macron, the French President, could be a historic step forward for the EU, of course, if it was to become a reality. And of course, in formulating the proposal, Mrs. Merkel broke two rules of Germany's EU policy, that there should be no common borrowing and no transfer union beyond the existing EU budget. So I was wondering, how would you comment this pivot in terms of politics?
Yeah, indeed. You are referring to the joint press conference that the French President Emmanuel Macron and the German Chancellor Angela Merkel did on Monday, 19th of May, which has proved that, especially now with the UK out, France and Germany are the leading force of Europe. They have said that they want to set up a temporary fund of 500 billion euros to provide EU budgetary expenditure. In the EU buzzwords these days, we are referring, of course, to grants rather than loans, and that is actually a big paradigm shift for Germany. Eyes were all on Angela Merkel back in April at the last European Council, the meeting of heads of state and government. Indeed, here a lot is about her legacy in leading the European Union and actually in shaping the European Union of the future. For the first time ever, actually, with this joint proposal put forward by Germany and France, Germany is backing the issuance of common EU debt that, of course, under the current treaty provisions is possible. The European Commission, if this proposal goes through, but of course there are, and we all know that already, some member states which are opposing it. If this goes through, it will be the first time for Germany to support such a solution for the EU fiscal policy, and some pundits have called it the Hamilton moment for EU politics. Indeed, just think that everything is in the court of Angela Merkel. She was leading the so-called frugal front, so the countries that do oppose the joint issuance of common debt in the European Union. But now somehow also with this solution, with this compromise that is put on the table by Germany and France, on the one hand, France is trying to appeal to the southern countries, and while Germany to the northern. It's true that if once we were used to speak of northern versus southern Europe, probably today and after this proposal, we will speak of loans versus grant Europe. What is for sure is that this 500 billion euros recovery plan proposed is earmarking funds that will be outright grants and not loans, which on the other hand is the buzzword of the opposing front, that of the frugals that I was mentioning.
In fact, considering the fact that 4 Nordic countries are not supporting this recovery fund, which is so far an idea of France and Germany, and of course backed by Italy and Spain, do you believe it's gonna, how can I say, become a reality? And what would it mean for Angela Merkel in terms of her European standing and home standing, within Germany? Because many people will disagree with her decision.
Indeed, first, at a European level, without Germany and France, no deal is possible. So better start negotiating from this proposal, President Macron said on Monday. And indeed, that is the bilateral proposal of two countries. Without those two countries, a deal is indeed not possible. But on the other hand, might be that also other countries like Italy are not they are okay with the proposal, but probably not super enthusiastic about only the 500 billion euros earmarked. On the other hand, Angela Merkel, if we look at also opinion polls in Germany these days, they prove that especially on the progressive front, and namely the Greens, which are the upsurging political force in Germany, and the Socialists and Democrats, which are in government with Merkel and a coalition government with Merkel, they do support this solution. So not only would this be a sort of Merkel legacy at European level, but commentators have started speaking of a fifth term of Angela Merkel. Well, it's true that she has quit the leadership of her Conservative Party since 1 year already, but indeed it's the succession also race in Germany in the Conservative Party itself is ongoing. And well, you know what? It might happen that Angela Merkel is there to stay also one more term if she's indeed proving to be such a leader in Europe and to lead a country also considering the adverse opinions that there have been in Germany so far vis-à-vis a fiscal EU policy. And just not to forget that also the Constitutional Court of Germany, just a bit more than 10 days ago, the 5th of May, also, it was unrelated to COVID, but they also spoke about actually it was a judgment about the quantitative easing, and then they were again stressing on the usual stances of Germany on EU spending. So that's the picture, but something more interesting, even when you speak of those four Nordic countries, and they are, let's name them, they're Austria, Denmark, the Netherlands, and Finland. Well, actually, all those four countries, they do have coalition governments with junior parties or even leaders like in Denmark and Sweden, who are from progressive forces of Europe, which have really at EU level been advocating for joint mutualization of debt. And it's going to be interesting to see how that develops from also a EU political point of view.
I was wondering, what is your assessment of the EU answer to the COVID crisis, especially compared to the US? If we look at it in terms of ECB answer, I shall say it's been pretty successful, very timely and targeted. But what about, from fiscal point of view, can we call it timely and targeted, or you would rather use another adjectives?
Probably not super timely, but on the other hand, this was a first time for the EU itself, and now probably we can speak openly about indeed EU fiscal policy in comparison to the past. Probably not super timely, but it's true that the EU, starting from what is the real core of its business, namely the internal market, started really putting on the table some strategies. For example, measures to lift national export bans, for example, those for medical equipment, and that is something Italy should recall pretty well, because that was at the very beginning of the COVID-19 crisis. And on the other hand, providing the necessary flexibility, for example, when it comes to state aid, to provide also support to the respective economies. If we look at the fiscal policy itself, the ECB has been, of course, enforcing its monetary policy instruments and tools, going to the as far as possible, to the extent as far as possible, with a new quantitative easing of 750 billion euros, and that goes also for the European Investment Bank. So it's not just what is going to be put now on the table, but a whole package of measures, for example, also to sustain employment levels in the member states, that is there. Probably, I mean, the European Union is not the United States, but I must say that the package, the rescue package that was approved by the United States, we are speaking of $2.3 trillion, well, that is nearly the 2 trillion euros of long-term budget the European Parliament, a key actor of EU politics, was, for example, calling for. Of course, probably we will not go that far in terms of spending, but it's worth remembering that this recovery plan will be integrated in actually a 7-year time span, a long-term budget. So it's not only the 500 billion euros that were put there by Germany and France, but let's wait for the actual proposal by the European Commission on Wednesday, the 27th of May, and let's see how this is also integrated in this more longer-term perspective.
Let me ask you one very last question. You just mentioned a few other measures that were already adopted on European level. For example, one of them is the ESM, very controversial in Italy, and already the government said that they're not going to use it. It's extremely controversial topic, at least here in Italy, but I shall say also on European level. So I was wondering if this recovery fund was to become a reality, let's say. Do you believe these 100 billion euros that are supposed to go to the Italian businesses are going to be enough to keep them afloat, and of course to help them go through this difficult moment? Because I want to confirm that many companies, businesses, especially SMEs, are still not working.
Yeah, that's absolutely correct. I mean, 100 billion, which is the figure that has been targeted for Italy, probably will not be enough, but we should indeed maybe complement that with other available figures you mentioned. It's extremely controversial also inside the current Italian government. You mentioned the ESM that can give loans at up to the 2% of the country's GDP. Well, that for Italy would account for 36 billion euros on top of the 100 of the recovery fund, should it become reality. Plus, you have also the European Investment Bank guarantees. So, I mean, and then you have the schemes for unemployment that I was quoting before. Let's say it's a cocktail of measures that Italy probably could benefit from, but that would also require some, if I may say so, some political maturity also from Italy, and go beyond the daily political debate and make use of all the instruments that are on the plate. The European Stability Mechanism we are speaking of today is not the same as that we know for Greece a few years ago. It's a whole new instrument. Of course, there is some sort of conditionality, a light conditionality, but let's remember that everything must be directly or indirectly linked to health expenses for the country, which makes it indeed somehow a different instrument that the one people fear can be activated for Italy.
All right, thank you very much. Gabriele Rosana, Policy Director at Culture Action Europe and a Spenia contributor. Thank you so much for joining us. Have a great weekend.
Thank you, Alexandra. It was a pleasure being with you. Have a nice weekend. Bye.
Thank you. Well, we're heading for a very short commercial break. Stick around, guys, because up next is our commodity analysis. We're going to have a very, very interesting panel for you. Welcome back, everybody. Trade tensions and tensions between the U.S. and China are weighing on the market. S&P 500 is down by 0.1%. Dow is dropping more than 90 points, and Nasdaq Composite recouping some ground, actually 0.70% in the green territory. The VIX index at the 2902 mark, and the FANGs are pretty mixed. So far, Facebook and Apple are trading in the green. Amazon, Netflix, Google, and Microsoft are off by more than 0.3%. I want to switch very quickly to the fixed income board. So far, the US 10-year Treasury is using 0.65, the 2-year 0.17, and the 3-month 0.12. Very quick look also at the Forex. The DXY is at 99.84. As we can see, today is on a rally mode, more than 0.4% in the green. Euro dollar declining by more than 0.5%, 108, and sterling against the dollar 1.21. Very quick look also at the commodities. So far, WTI is trading $32 per barrel, off almost 3%, and the Brent $34 per barrel, off as well, 2.95%. Of course, the trade spat. And not only the trade spat, actually the tensions between the US and China are definitely ramping up, and this has major impact on financial markets, not to mention that Beijing scraped its GDP targets for the very first time in a decade. So in order to weigh on the situation, I want to bring to the show Konstantin Simonov, head of Russia National Energy Security Fund, and Philip Schreibel, senior analyst, Blue Line Futures. Good evening, gents, and thank you so much for joining us.
Hello.
Thanks for having me.
Well, Phil, I want to kick off with you. We saw a significant increase in oil prices. Of course, after OPEC Plus made significant output cuts, and of course, Saudis mostly, they even promised additional output cuts. So are you, how can I say, bullish on the oil price in the long run?
Not really. I think that oil prices have kind of achieved their near-term upward objective. I think that oil prices, from this point going forward, I think it's not stagnant, it's slightly lower. What's cautious is the overnight action we saw is about a $4 range. I think that OPEC did a great job on reducing some of their production. U.S. shale producers obviously had a big hit from the price of oil declining. That shut off a lot of production. U.S. demand is starting to come back a bit as far as driving is concerned with some of the
Phil, we have some problems with the line. We don't really hear your connection. It's very bad. We're going to try to reestablish the connections. Konstantin, let me ask you, what do you think about a sudden increase in oil prices? Do you think this is going to last longer? And of course, considering the fact that China skipped its GDP forecast for the very first time.
Okay, I hope that my signal can be a little bit better. So, of course, we have two types of good news. First, of course, is OPEC Plus. You said about this. So from the 1st of May, we started the implementation of this deal. And for example, Russia and Saudi Arabia already implemented the goals of this deal. So today's the production of Russia is 8.5 billion barrels per day. So it's absolutely according to this deal. The same situation with Saudi Arabia. So we eliminated approximately 10 million barrels from market. Of course, it's a very huge positive signal. And another type is, of course, increase of consumption. We see very good news from Italy and from other European countries. So we see, of course, not the end of this self-isolation and so on, but the first positive and good signal. So we see the increase of consumption. We are waiting for the new flights, increasing of the amount of transportation of commodities. So that is why we see not so bad prices. Today, for example, Urals price, the price for Russian oil is approximately $35 per barrel. I remember in April, on some days, the price was less than $10. So that is why $35 in the situation of coronavirus and this pandemic is excellent price. So we can say we are satisfied with such news. First good news that we see some increasing of consumption with decline of production.
I was wondering, Konstantin, what do you think about China and China as a factor, because they're one of the most important crude oil buyers. So how much of an impact might poor economic data coming from China have on the crude oil demand and, of course, price fluctuations?
It's a very good question, of course, because we see that the decline of consumption in China was not so huge, and you of course know very well that the start of this pandemic was in China, and when we see pandemic in Europe, in Russia, in India, in the United States, in other countries, we see already there some increasing of economic life. We see some economic growth in China, so that is why we see that situation with consumption was not so bad in April, and now the situation in Chinese economy is not so dangerous. Yes, this week we read about possibility of the second maybe wave of coronavirus, but it's only, in my opinion, today it's only the rumor and not only. But I mean that it's the not clear scenario. So that is why now the situation with China, we are speaking about consumption, is not bad. For example, in India, we see the decline of consumption more than 90%. Even in the peak of coronavirus pandemic in China, the situation was not so bad. And we see some restore, and very fast restore, of Chinese economy, and that is why the situation with consumption is very good. But you started with a trade war between China and United States. For Russia, for example, it's a very important story, because you know that United States is trying to increase the consumption of American oil, and United States is trying to press on China, and of course Russia now is the biggest oil exporter to China, is the biggest supplier. So that is why we are anxious, of course, about the future steps of Washington, and for us it's a very nervous news.
Right, Phil, what's your take in terms of demand and supply?
Well, the United States, we're starting to come more online with the shelter-in-place being lifted, so the driving consumption, gasoline consumption has been going up, with supplies coming down quite a bit. We think prices have come up to an equilibrium level. We don't anticipate too much stronger prices from here. We actually think prices might decline a little bit lower due to the fact that we're not seeing any pickup in growth. We don't have much inflation. The number of jobs that have been lost is significant, that will not come back. So we just think a pure supply demand, we think demand is going to remain low for an extended period of time.
And which are going to be, the main drivers for the crude oil price in the upcoming months?
Well, we still are looking at, that possibility of a trade war, but we're looking at the economic data. The economic data just appears to be extremely weak. It's not coming back, and it's not going to rebound at all for quite a while. I mean, you're looking at lower growth, lower inflation, which creates stagflation, and that tends to weigh in on all commodity prices.
Konstantin, I was wondering how much of an impact has this, crude oil decline on Russian economy, because it really depends on the crude oil exports.
Of course, it's a serious shock for our economy, but our budget was ready for such shock scenarios, because I think it's not a secret that in the period of high prices, we try to collect money in our stabilization funds, and at the beginning of this crisis, the amount of money in our different funds was approximately $580 billion. It's for us it's a huge amount. And now, I remember in February, our Minister of Finance, he made the forecast that even if oil prices will be would be, if oil prices would be $30 per barrel, we can survive for 7 or 8 years. Because it's interesting that in February, $30 was like the most dangerous forecast. Now, of course, the situation is absolutely different, but today, Urals price is more than the most dangerous focus of our Ministry of Finance in February. So it's approximately $35. So that is why situation is, of course, very difficult, because we have not only cheap oil, we also have the impact of coronavirus, we also have isolation, we also see a lot of people who are losing jobs and businesses closing. So that is why the combination of these two factors, of course, it's bad news for Russia. But as I said, $580 billion as the amount of money inside our stabilization funds at the beginning of this crisis is a huge pillar of security. So that is why I hope that the situation will be not extremely difficult.
Phil, on the other hand, you know, the shale oil companies took a major hit in the U.S. During this crisis, starting, you know, with a price war between Saudis and Russia. What's the current situation? Do you believe these companies are going to, you know, pick up and I don't know, stay afloat and, of course, run into the long term?
Yeah, that just hearing the other guests talk, it explains how the different dynamic is between like a country like Russia that can produce oil at extremely, cheap values, and same thing with, Saudi Arabia. They are gifted with their infrastructure that's already set, and they are easy to access, oil and things like that. Where the U.S., the process is relatively new, and for shale drillers and pumpers, they have leveraged themselves with a lot of debt, anticipating that oil prices would be $50, $60, $70 going forward in a robust economy, which they should have been. But due to the coronavirus hitting them, we saw debt levels that companies are unable to continue to produce. So it took a dramatic turn against those U.S. shale producers, and that might not come back online until we see prices at elevated levels. And again, back to the economic data in the U.S., it should remain quite weak for quite a long time. We're very surprised that U.S. equities are as high as they are, and don't let high U.S. equity prices fool you into thinking that the economy is doing well.
Konstantin, I just want to ask you, do you believe the squabble between Russians and Saudis is over? Because let me highlight the fact that the major decline of crude oil price started with this price war between the two major producers. And then, of course, the coronavirus, which completely shut the entire world, had the major impact. But it started, with a price war. Do you think this is over, considering the fact that both countries took a major hit?
It's, I think, one of the most important and interesting question. Important for Russia, of course, because you're absolutely right. Our relations with Saudi Arabia is very, very interesting and strange during last several months, because, of course, you remember the collapse of the first OPEC Plus deal on the 6th of March this year. Then Saudi Arabia started the real price war. They began to give huge discounts for the consumers, especially in your region. Then Russia returned to the, if we can say, table of negotiations. Then we signed the second OPEC Plus deal on at the middle of April, at the beginning of April, on 9th and 10th of April. But then Saudi Arabia gave another discounts in May. So Saudi Arabia signed an agreement with Russia, but continued price war with Russia. But only now we see that Saudi Arabia changed prices. We see that Saudi Arabia gave more high prices for June, and for us, of course, it was good news, and it was one of the most important factor also for the increasing of oil prices, if we're speaking about global prices. But it's still an open question. What will be the next steps of Saudi Arabia? What will be their next next steps. And this competition between Russia and Saudi Arabia, and also with American shale producers, this competition is not over. And in my opinion, the most interesting question is not the situation, today's situation with prices and impact of cheap oil for Russian economy or Saudi Arabian economy. The most important question is how fast Russia, Saudi Arabia, and United States will restore the level of production when the prices also will return to more comfortable levels. Because this is the most serious question. Russia decreased their production of oil by 19%. It's a huge amount. For us, it was a unique situation. And it's still a question, can we return very fast to the previous levels? This is the most important question and the most important part of this war between Russia, Saudi Arabia, and the United States shales producers.
Phil, I couldn't hear your opinion previously, regarding the China as a factor, because we saw that it decided to skip the economic target for 2020. How important is China for the energy market, especially for the U.S.?
Well, I mean, they're a massive consumer of U.S. energies and a consumer of all different various goods from the United States. So we are very concerned about that, but you're seeing, it's one thing for companies to stop issuing forward guidance, which has been a strategy used amongst most U.S. equity companies going forward. But for countries to implement lack of forward guidance, that's a little bit nerve-wracking because, people have always questioned some of the economic data that's come out of China. Whether you believe it or don't, it's irrelevant. There should be consistency on economic data releases, no matter how good or how bad they are. And, it just it leaves an unsettling feeling with people that rely on China.
We are receiving some questions, and one of them is, do you believe we can expect a major slump once again? When I say major slump, I'm talking about -40, which so far looks like impossible. Phil, are you there?
Was that? Yeah, I'm still here. I mean, we believe that U.S. equity prices are going to come under another degree of pressure, and we are going to follow the same global trends that we're seeing out of like the CAC 40, the DAX, your Thailand, your Australian, all those indices going lower. We believe that oil prices will come under that same degree of pressure and track those lower. The divergence between U.S. equities and oil have already occurred. However, we think going forward, we think that things are going to come back together and travel together. And again, I'm not optimistic, and most people are not.
Konstantin, let me ask you one very last question. What would you advise our, retail investors and, of course, institutional investors?
Advice about what?
About the energy market and, of course, the crude oil price and possible movements.
So, in my opinion, only crazy persons can give you focus about oil prices today because the situation is absolutely unstable and unpredictable. And you need to ask this question not in Moscow, you need to ask this question in Milan and Italy. What will be the situation with coronavirus in Europe? Are you waiting for the second wave of this coronavirus? But in my opinion, we'll see slowly restoring of consumption of oil in the world. I hope that there will be no huge second and third wave of coronavirus in Europe. We will see the restore of consumption in India, in other parts of the world. So that is why, step by step, not so fast, but I think that the oil prices will be in diapason between $35 and I think $45. If we are speaking about euros or Brent oil. Of course, it's not a huge price, but I hope that we'll see very slow, but some restore of oil prices, and I'm still an optimist.
Phil, very last question. What's the next target for the gold?
Oh, for gold, I think gold prices are going to continue to travel higher. I'm actually doing an analysis right now, gold versus every major currency out there. If you look, they're all turning gold in any currency that you hold. British pound, Australian dollar, US dollar, Japanese yen, doesn't matter. Gold prices are going higher. And once we see US equities begin a second decline, we should see about a 6% gain in gold, as that's what it about averages on every second phase of a bear market. So I think near term, we could see, 1850 by the end of the next quarter, and then ultimately year-end target of 2000.
All right, fantastic to catch up with you. Phil Stribel, Senior Analyst, Blue Line Futures. Thank you for joining us and have a great long weekend. And Konstantin Simonov, Head of Russia National Energy Security Fund. Thank you for joining us.
Thank you. Bye-bye.
Have a great weekend. Well, that was the very last story for this evening. Thank you so much for watching, guys, and see you on Monday exactly at 6:30 p.m. on Fonti TV.